broadly, I've been attracted to natural resources really since my mid-teens. I suspect, but don't remember, that that's because I like to be out of doors, which is ironic because that led me to a profession trapped in an office for the last 50 years. But I have been interested in investing and interested in natural resources as a subject since my mid-teens. I'm extremely lucky that I had the sort of discipline to pursue that. I went to the University of British Columbia, although I'm American. At that point in time, it was, as far as I know, the only degree granting program in natural resource finance in North America. I mercifully, as a very young man, fell into the right slot in life. And I've done effectively the same thing for my entire business. I think the most important thing that any investor can do is come to know himself or herself. I think further, and I will answer the question, Jesse, I promise. I think further, the greatest risk any investor faces is conveniently located to the left of his or her right ear and to the right of his or her left ear. And the question you ask is very appropriate. I define investments as an allocation of capital with the expectation of the probability of making a suitable rate of return. I consider speculation the taking of substantial risk in anticipation of the possibility rather than the probability of outside returns. I have been, for most of my life, both a speculator and an investor. I did it backwards from my point of view. I was a speculator first and an investor later. I got away with it. I was extremely lucky. I worked extremely hard. Most people, I think, should invest before they speculate. But of course, the choice is theirs. We need a couple more definitions now, beta and alpha. I define beta as the outperformance of the sector relative to the broad market. So if you suspect that natural resources or oil or something in a macro sense will outperform broad equities markets, that outperformance, by my definition, the delta is beta. Alpha is different. Alpha is, from my point of view, the outperformance of one company in a sector rather than the rest of the sector. When people seek to invest or speculate for their own account, I encourage them to limit the number of companies in their portfolio to the number of hours they plan to spend per month. So one company, 1 hour per month. If you have 10 companies in your portfolio, I believe that it is reasonable to expect to have to spend 10 hours per month. And by 10 hours a month, I don't mean, however pleasant it might be, listening to videos of Rick Rule discussing broad homilies on commodity culture. I mean reading annual reports, reading quarterly reports, reading press releases, reading 43 101s, reading the proxy statements, that kind of thing. What I found in my life is that most people would be their own best portfolio manager if they did it, but they won't do it. And for those people, either people who don't have a large enough portfolio that it's irrational for them to spend the amount of time that would be required managing that portfolio, or for those people who have a life. They want to go to kids' or grandkids' baseball games, they want to fish, they want to read, they want to garden. In that circumstance, what you say is absolutely true. If you will do the work to outperform the market, you can outperform the market, but that presupposes that you are ready, willing, and able to do the work. In 50 years, 49 actually, of assisting investors in managing their own money, what I've learned is that only a precious few are willing to invest in the education required to do the work, and in turn, for most willing investors and speculators, they haven't done enough work on investment fundamentals. I would begin by reading a very simple economics text called Economics in One Lesson, which from my point of view teaches the way the economy works, rather than the way that you were taught it works, assuming that you had the poor fortune, like I, to go to university and be taught mainstream economics. Having done that, by the way, it's an easy book to read. Having done that, I would suggest that you read the world's best investment primer, which is in fact The Intelligent Investor by Ben Graham. I believe it's the best investment book ever written relative to the effort required to read it. It's important, however, that you read it. I've probably caused 10,000 copies to be bought. I have no idea how many I've caused to be read. And if you are going to be serious about investing, then you need to read the magnum opus, which is Securities Analysis by Graham and Dodd. It is a very hard book. It's a wonderful cure for insomnia. I never stop reading it. When I finish it, I begin again at the beginning, just to remind myself of the precepts in the book. Once you have the basics down, then I think the right way to do it is simply to begin to do it. I think you look at balance sheets and income statements, pick the company that's the biggest company in your portfolio. I know this is going to sound daunting, but it's the way you learn how to do it. Get 5 years of annual reports and quarterly reports. If you get them in paper, unstaple them so that you can lay them out. And read the CEO's statement and mission and try to figure out whether or not that mission was fulfilled. Look at the interplay between investments that the company made and increases in book value per share and increases in free cash flow per share. Try to determine whether investments were made at the bottom of a commodity cycle when they should be made, or at the top of a commodity cycle when they shouldn't be paid. Look at important ratios, particularly in pre-production company, like the proportion of total capital raised spent on general and administrative expenses relative to project expenses. And if you're in early stage exploration companies, try to figure out if the management team is double dipping, which is to say getting paid to run the company and then being paid as a geological or marketing consultant on top. It's important to note whether or not your investment or speculation is well run. It's important to note whether your exploration company is a lifestyle company. One more thing in this topic, if I may, Jesse. It's important to note among the juniors that they're really a minefield. I have made, by my standards, an insane amount of money in the juniors, but I've taken insane risk and I've worked very, very, very hard. If you were to merge every junior mining company in the world, listed junior mining company in the world, the American listings, the Canadian listings, the London listings, the Australian listings, if you merged them all, maybe 2,500 companies into one company, called that company Junior Explorco, in a good year, that company would only lose $2 billion. That is to say, expenditures over receipts. In a bad year, it would lose $6 or $7 billion. So when you look at the sector as a whole, what are you willing to pay for a business that loses $2 billion a year? Should you pay 6 times losses, 10 times losses? In a bull market, you might have to pay 15 times losses. That hides the fact that probably 5% of the issuers generate so much performance that they add legitimacy and occasionally luster to a sector that can be counted on destroying capital year after year after year. The point of all this is that if you're not going to do the work, don't get near the sector. You know, it's odd that when I was a young man and had lots of time left on earth, I was very impatient. Now that I'm an old man and time is tight, I've become very patient. It isn't that my time preference has changed. It's that I've lived through now 10 5-year cycles in my life, and I've learned that 5 years is a reasonable expectation to make real money. Compounding is the first wonder of the investing world, particularly in speculation. What I have learned is that making money in speculation, in exploration, is really about answering a series of unanswered questions. And it isn't about just answering one, it's about answering 3 or 4. If you assume that every unanswered question requires a new field season, you have to go through 3 or 4 or more field seasons. It doesn't mean that you have to own the stock for 5 years. In fact, if you discover that your expectations were wrong, that it is unlikely that you're going to get a yes answer, you must sell the stock, whether or not you are up or down on it. But my experience, and I've done some pretty serious work back testing the 10 baggers, the 1,000% gains that I've enjoyed over my life. The median 10 bagger has required between 5 and 6 years. And by the way, the median 10 bagger, at least once in the course of holding it, has fallen by 50% or more in terms of price. So in addition to being patient, you have to be very persistent. On the beta side of the business, that requires time too. Natural resource-based businesses, commodity-based businesses are capital intensive and cyclical. And they're a trap for somebody with conventional thinking. During periods of time when commodity prices are high and cash flows are high, earnings are high, very often the company's price earnings ratios are low. And we're taught to think that low PE companies are valuable companies. But if the low PE is a consequence of abnormally high commodity prices, what happens is that commodity prices self-correct, meaning that you're setting yourself up for a trap where commodity prices collapse. What you need to do as a beta chaser, as an investor in natural resources, and this is really hard to do, you need to buy commodities that are so deeply out of favor that the industry is in or close to in liquidation. If you find a commodity where the global production cost is higher than the median price received for the commodity, you have a circumstance where either that commodity price goes up or the commodity itself becomes unavailable to consumption. The turnaround, the time required for the market to work and the commodity to rise in price isn't something that happens in a quarter or a half or a year. In order to play this game, you very often need 3 to 5 years to be right. Now, a side note, there are certain circumstances where commodities sell off very, very, very dramatically due to other than permanent events. One example would be 2.5 years ago, the COVID shutdown of the transportation industry that took the oil price from $80 a barrel to sub 20, all the way to sub zero for one weekend. That circumstance was very clear. It was very clear, given that the oil industry was underinvesting in sustaining new project investments by about $1 trillion a year, that oil production wasn't going to be maintained and that the oil price would come back sooner than would otherwise be the case. And that, of course, happened. We round-tripped that oil price decline in 2.5 years. Don't consider this to be normal. Hopefully, COVID and circumstances like it won't become normal. But normally, the time frames required in either investing or speculating exceed the time frames that most people who are practitioners feel comfortable with. That's just the fact of life.